Hello, I'm Russ Mould, AJ Bell's Investment Director, and welcome to the latest edition of Fundamentals, where I'll be looking at one of the most popular investment trusts on the AJ Bell Youinvest platform at the moment, namely Murray International. This closed-ended vehicle is run by Aberdeen Asset Management under the guidance of fund manager Bruce Stout, a very experienced money manager whose Aberdeen career actually dates back to 1987. Now, Murray International's mandate is to beat its benchmark and maintain an above-average yield, providing both income and capital growth to investors. Murray International lies in the global equity income category, and at the moment it offers a dividend yield north of 4%, which is paid in 4 quarterly instalments. The trust has around £1.7 billion in assets under management, and it's big enough to be a member of the FTSE 250 index. Stout invests those assets across stocks and bonds around the world. Now, as I sit here, shareholders' money is invested in 47 companies and 21 bonds, with equities representing around 85% of the assets and fixed income around 15%. Note that Stout can put money to work in the UK as well. British American Tobacco is the biggest individual shareholding, but that's one of only 2 UK quoted stocks in the top 20. The other is Royal Dutch Shell. Other key equity investments include Taiwan Semiconductor, Mexican airport operator Assur, Unilever Indonesia, and American tobacco giant Philip Morris. Leading bond holdings include debt issued by Mexico's oil giant Pemex and the Brazilian, South African and Indonesian governments. Overall, Britain represents only around 13% of the equity portion of the portfolio, at the moment anyway, and the split of the stock element is interesting. The trust is hugely underweight America, underweight Japan, overweight Asia, overweight Latin America, as this graphic shows. Now, Latin American and emerging market debt also dominate the fixed income weightings, with the US not getting a look in. This next graphic shows the percentage of the overall portfolio that's represented by bond positions by geography. Now, by sector, on the equity side, consumer staples, telecoms and financial services are the big 3 weightings, while there's no weighting in consumer discretionary and very little in utilities. A few final points are worth noting. 1, the trust comes with 11% gearing, so it does use debt to leverage returns, though this will also magnify any drops if its investments fall in value. 2, the trust currently trades at around a 5% discount to net asset value. And finally, Murray International has scrapped its performance fee and cut its annual charge, which now comes to 0.75% a year. So, those are the mechanics. The question to address now is, why are your fellow investors buying Murray International at the moment? And I think there are 4 possible reasons. First, that 4% plus dividend yield will catch the eye of income hunters, and that's where the bond portfolio in particular will also have its uses, providing an income underbedding. Second, the overseas exposure will benefit from sterling's ongoing post-referendum pre-Brexit slide. Third, this is an investment trust with a strong long-term track record that's slightly fallen on hard times but could now be on the way back. Looking at data from the Association of Investment Companies website, in a field of 9, Murray International ranks top in terms of performance over 10 years, dead last over 5, and top over the last 12 months. And this chart here shows the investment trust shares over the last decade. And fourth, Stout is a well-known skeptic when it comes to negative interest rates and quantitative easing, and he's also a value-hunting contrarian. That explains why he's underweight the US and overweight emerging markets, especially as the latter have underperformed hugely for the last 4 or 5 years. Now, equally, that means this investment trust may not suit everyone. Not every investor will feel comfortable with the big emerging market exposure on the stock or bond side, and there's no doubt that Stout's contrarian view had hurt performance until this year, when his doubts about whether unorthodox monetary policy is doing any good are becoming more common currency. If you are wary of central banks, feel American stocks are overcooked and that the UK's got deep-rooted debt-related economic problems, then Stout may be your man. But that's something only you can decide for yourself. Thank you for watching, and I look forward to seeing you next time.